It seems like now more than ever, finance, stock investing, really just investing in general is seemingly on top of mind, especially with the new stimulus announcements and more. So I wanted to take the chance to really educate myself and you watching this about really just some investing 101 in this video. So I brought on an expert, the president of financial planning, certified financial planner, EA, Stephanie McElheny, to help us really understand, nothing too complicated, really just, again, to help us understand investing 101. So with that, let's bring Stephanie on for the video today. Stephanie, how is your day going? Coming to us from the Metro Denver marketplace.
Yep, it's pretty good. How are you doing, Mike?
Doing good. And I appreciate you watching this video.
Yep.
Again, this is going to be a great framework for, again, investing 101. I don't want to get too in the weeds here. I just want to educate you watching this, just some high level understanding of, hey, maybe I'm liquid or maybe I have some money I can use for investing. And let's also acknowledge if you're not liquid, if you don't have really discretionary spending right now, that's okay. You're still going to want to watch this video to the end, just simply for the education, because this is something you might want to look at a little bit down the line. So Stephanie, appreciate you being here again. Let's just kind of start out with the basics here. We're talking about investing. Can you kind of just define that at the high level, just kind of in the basic terms?
Yeah, so investing is essentially you're taking your money and you're purchasing either ownership in or debt of companies, and essentially the hopes that the return you receive is going to be more than you put in. And in this case, return can come from capital appreciation or income.
And again, starting this video, I definitely feel like there's a lot of buzz right now, specifically in the stock market with Webull, with Robinhood. We see all these investing apps. I myself really got started last year. Really just that, starting my own investing portfolio. So how does investing relate to that, the stock market?
Yeah, so stocks are, sold in the stock market. Bonds are sold in the bond market. And a lot of people right now probably are familiar with hearing about like the Dow Jones or the S&P 500. And those are some of the bigger stock markets, or indices, I should say, in the stock markets. And it's really just, they're comprised of some of the biggest companies, the biggest stocks. But it's actually interesting. What a lot of people don't realize is the bond market is actually bigger than the stock market. So the stock market gets more press. And like you said, it's in the media now with Robinhood and Reddit, Wall Street Bets, and GameStop and everything else. And so, typically people think of stocks as kind of the sexier investment, and they're always talking about those indices, the Dow Jones and the S&P. But in fact, the bond market is actually significantly bigger than the stock market, just in terms of the actual market that it's looking at and trading in, and then the actual trading volume of bonds. So, little fun fact for people.
Well, I know you mentioned, I just want to kind of take a step back here about, the definition. We're talking about just investing in general here. Because I heard you mention capital appreciation, specifically, income as well. Can you just kind of define those terms for us?
Yeah, so capital appreciation, that's kind of just the growth of the company. So, people are talking about GameStop a lot, and this is by no means any sort of recommendation or anything like that. Just, with that being top of mind for people. A lot of folks, for various reasons, think the price is going to go up, so they want to get in while the price is low and then have it appreciate. Think of like, the real estate market or houses or something. You're hoping that, you're going to buy your house and it's going to appreciate in value or grow in value. So capital appreciation as it relates to stock is just growth of a company. So think of it this way. Let's say you buy a stock for $1 and you sell it in 6 months for $1.25. That's a 25% increase on your investment. So that's that piece of it. Then income is things like dividend and interest. Kind of the most real world example of this is if somebody has like an online savings account, or they have a credit union, or whatever it is that they use. Hopefully you're getting some interest on that. So a typical checking account probably isn't going to get you interest. A savings account might. Now, that being said, it's probably only like 0.5% or something, but better than nothing. But that's interest. So interest and dividends are actually income you're getting, and that's not something that you're kind of having to sell to realize the appreciation and the growth. It's just income given to you either from the bond or cash or stock dividends or something like that.
Right. And, if you're watching this video and you're considering investing, and Steph, I'm going to ask you about kind of the delineation of stock versus bond here, because I think
Yeah.
we should kind of define that. But if you're watching this and you're considering investing, now, of course, this is not legal financial advice from either Steph or myself, but I started, again, with my investing portfolio really last year because, as you mentioned, the interest on, savings accounts is kind of next to nothing, let's be real here. And there's really opportunities, in my opinion, obviously, if you make smart financial investing decisions. Of course, there's volatility and risk. Again, no earnings claims here. So let's define then, just for you watching this here, what is that delineation, the definition of that stock versus bond, especially because you said that bond market is actually larger than the stock market.
Yeah. So let's start with stocks because, right, those are what's in the news right now. So it's essentially just an ownership stake, or, we talk about shares, trading shares of stock in a company. So over the long term, stocks are typically going to provide superior returns to bonds, but they are going to be more volatile and they are going to be more risky. And when I say volatile, think of that as just the ups and downs in the market. So depending on, what the market's doing in a specific day, the stock price could jump around quite a bit. Bonds probably aren't going to jump around as much. So, and I'll talk about bonds here in a second, but essentially, if you're looking at a stock and you want to buy, a stake in a company or some shares in a company, you're doing that because, you think they have strong financials. You expect their revenues are going to be good. Maybe they have an exciting product in the pipeline, things like that. So, and as more people want the stock, the more the price goes up. So that's kind of what a stock is at its most basic. It's just kind of an ownership stake or ownership share in a company. A bond, now that's debt of a company. So, it's essentially like if you're buying a bond, and you can buy bonds from companies, you can buy them from municipalities, but you're loaning money to that company, to that municipality, and you're hoping to get paid back with interest. So, and that interest payment is essentially them compensating you for the risk and time, that it took them to pay you back. So, and depending on, the quality of the company or the municipality, if they're riskier, then you're going to get more in interest on that. But typically, overall, from a broader perspective, bonds are, what we would say safer than stocks because, again, they are typically less risky. They're less volatile. But the flip side, the sacrifice to bonds is that there is less long-term growth potential. But the benefit to bonds is they provide kind of a more of a steady hand in the portfolio. Sometimes we'll even call them an insurance in the portfolio. And they kind of provide that safer aspect of investing.
Well, I tell you, I appreciate the value that you're giving here. If you're getting value in this training today, definitely drop a like. I was watching a live stream this morning, looking at the stock market, bond indexes, the 5-year, the 10-year, the dollar index. Yep. There's a lot to this. So again, if you're getting value in this high level, if you want to see more education on just investing 101, a little bit deeper, maybe in stock investing, et cetera, let us know. But now I saw in that video, just watch some other videos, talk about mutual funds. Can you define that? Just kind of give us a high level of what a mutual fund is.
Yep. So a mutual fund, think of it as a basket of stocks or bonds or both. So you can have stock mutual funds, you can have bond mutual funds, you can have a mixture of both of those things. So really a mutual fund is just saying, here's this grouping of stocks or bonds or combination, and they're going to have different investment objectives. And really you could have an infinite outcome of mutual funds, but they all have different purposes. So some are meant to be more aggressive, some are meant to be safer, some may only be in certain industries. So for example, there might be mutual funds that are strictly invested in stocks. Or there could be mutual funds that are strictly, short-term municipal bonds. Like the options are endless. There's international mutual funds. So it's just, ex-US type of investments. There could just be mutual funds that invest in the US. So it really kind of just gives you a broader access to multiple stocks or bonds. It gives you kind of easier diversification because instead of just buying all of your own stocks or bonds, you get access to a much broader universe of both of those things through a mutual fund.
Well, I appreciate that. It seems like, just educating yourself on the different investing tools, right?
Yeah.
If it is the debt in the company with bonds, it is purchasing a share of the company, is it a stock or that portfolio in the bonds or the mutual funds market rather. Well, I mean, that kind of in it of itself is diversification, it sounds like.
Yeah.
I'm again getting new into the whole app investing again with the Webull, with the Robinhood, not sponsor or anything, but I'm seeing all these things, being
Yeah.
really a new investor here. Talk to me about diversification. Again, give us a definition of that, maybe what new investors should be considering here.
Yeah. So, at its core, diversification is spreading your risk across multiple different types of investments. So, here's the thing: the market and the economy go through cycles, and a ton of things can have an impact on, or be impacted by the market and the economy. So that could be interest rates, employment. We call it consumer spending. So, folks like us, what are we spending money on, and how much are we spending money? GDP, which stands for gross domestic product. So what are we producing as a country? Inflation, all those things. And it's important to note that all of those things can have an impact on stock and bond prices. And historically, stocks and bonds are actually negatively correlated. So, if we go back to high school math, maybe middle school math, I don't remember when, we went to high school and middle school together. So maybe you remember when we learned that. But, when one thing goes up, one thing goes down. So negative correlation is one goes up, one goes down, or one moves this way, something else moves that way. That doesn't always hold true. Historically, that's mostly been the case, but it does explain why diversification is so important because, again, you're spreading your risk by having multiple different types of things in your portfolio. So, let's use an example that you have a 50-50 portfolio. So that would be 50% equities or stocks and then 50% fixed income or bonds. In a certain environment, depending on what's happening with some of those, factors I talked about or variables, maybe your stocks are doing well, but your bonds aren't. So, if your bonds are performing poorly in that environment, well, your stocks are going to help offset that impact. And so then you might say, okay, Steph, well, if stocks are going up and bonds are going down, why wouldn't I just invest in all stocks? That's a very valid question. So, but here's the thing, the reverse could be true. So in other periods, depending on the market cycle or the business cycle or anything else, maybe bond prices are going up and stock prices are going down. Or maybe, at the very least, one of those things is steady while the other one's a little bit more volatile. Good advice is you should have a portfolio where not everything's moving in the same direction or not everything's going up and down at the same time. Because, if everything's going up at the same time, well, you might be like, that's great, making a ton of money, but chances are if something then goes wrong, or there's something that is unfavorable that comes out about, one of those variables or whatnot, then everything in your portfolio is going to go down. So you want some winners and losers kind of in your portfolio at any given point. And then, when things get too high, so like I said, let's say your stocks are going up and your bonds are going down. Well, that's probably going to mean that your stocks are then overpriced. And so you should probably sell them if they're overpriced and then buy things that are underpriced, or the value is low. So basically you're buying on clearance, you're buying on discount. So, you want to sell your winners and then buy the losers. And that's really what we call good asset allocation.
Well, I appreciate that. Firstly, I have been, watching the stock market daily here, learning new things, learning about, rotations, sell-offs in the tech space we've seen in the past couple of days here, the red days, candlesticks, all this really interesting stuff in the stock market. It's really fascinating.
Yeah.
It is. It's very fascinating. If you're watching this, I definitely encourage you to do some research here. But you mentioned a last point there about asset allocation.
Yep.
How is that different than the diversification that we just talked about? Is it different? What exactly is that?
Yeah. So diversification, like I mentioned, is spreading your risk across different things, but kind of in a way that's asset allocation too, because you're splitting things between stocks, bonds, maybe cash. So different components of your portfolio are invested in different, what we call like asset classes, if you will. So, and here's kind of the big takeaway, Mike. So, everybody right now is talking about like the day traders and timing things and,
sure,
GameStop and Wall Street bets. And, again, it's all this, everybody wants to think that this is like super sexy stock picking and, finding that right stock. But in reality, that is not the case, like at all. In the real world, less than 5% of the success of somebody's portfolio is going to be due to correct stock picks or market timing. And we don't do either of those, in our profession as CFPs, certified financial planners, or at our firm, because that gets you into trouble. Just trying to pick certain stocks and time certain things. People love to kind of build that up in the news and the media and everything, but more often than not, it backfires. Asset allocation actually is far and away the biggest determinant of somebody's success in a portfolio. It accounts for 95% of a portfolio success. There's been tons of studies on this. So at its core, we're just talking about if you're using proper asset allocation, you're allocating a portion of your portfolio to stocks, bonds, like I said, maybe cash. But the goal is to keep your allocation roughly the same, regardless of what's happening in the market. So, if things get a little bit out of whack, that's not that you're making trades necessarily every day or something, but that you're making tweaks to kind of keep yourself in a rough, allocation or proportion of those things. So, again, I talked about the 50-50 portfolio, 50% stocks, 50% bonds. Again, let's say stocks are doing really well, bonds aren't doing as well. Then things are going to float, right? So instead of being 50-50, if stocks are going up, bonds are going down, you may look at your portfolio again and see, oh, I'm at 60% stocks and now only 40% bonds. So if you want to get back to 50-50, well, that means you're going to have to trim some of the stocks, which is good because they're doing well. And then you're going to buy some of the bonds. And kind of similar to before, you might think like, well, why would I sell the stocks if they're doing well? And why would I buy bonds if they're not doing well? Again, super good questions. So we do that for a number of reasons. We might think that the stock is overvalued at this point. Maybe it's going to pull back soon. It's overpriced, or, bonds are poised for a comeback for whatever reason. And so teaching yourself to kind of reallocate and saying, hey, I'm going to sell my winners and buy some losers to get myself back to that 50-50. And I'm just using 50-50 as an example. Your allocation could be 100 equities, 0 bonds, or the reverse, or 60-40, 70-30, whatever it is. But keeping on top of good asset allocation really does kind of force you to sell your winners and buy your losers. And that is a great long-term strategy. And typically that's where people find the most success.
That is super powerful. Again, me as a new investor, I'm doing all my, it looks like we need to talk more, especially about the diversification and the asset allocation here. Because, I'm heavy in stocks. And like you mentioned, that is the thing that everyone's talking about. Everyone's talking about the Wall Street bets and the GameStop, the AMCs, and all these kind of meme stocks that we're hearing here. But you mentioned 95% statistically of the financial data that's telling of leaning towards success is, it's smart asset allocation, diversification, like you mentioned. So we really defined, stocks, bonds, mutual funds, diversification here. So if I'm a new investor, or if I've had some experience here, what do I do next? If I'm ready to invest, what's kind of my next moves here?
Yeah, so, Mike, I would recommend people check out, we're going to be doing another video, everyone, about what are the next steps. If you're thinking, hey, I have some cash on the sidelines, or, I have some free, excess cash flow every month, maybe I want to put it to use, I would recommend looking into that, because that's where we kind of go through, what should your first steps be? What should your considerations be? What should you be aware of? It can be very exciting, but there's also risk attached to investing. So in that next video, I'd love to talk to you folks more about kind of, like I said, considerations and things to be aware of, and how to prepare yourself to start getting involved with the stock and the bond market.
Well, I love that, Steph. I appreciate you being here on the channel again. So if you're watching this, your next step, like Steph mentioned, we have a whole playlist. We have future videos talking about not only finances, investing, but also taxes if you're in this gig economy, if you're a freelancer, if you're a contractor. So what I want to do is actually link that entire playlist right here. Now, also drop a like on this video if you got value. And I do want you to click or tap the screen here so you can see that entire playlist so you can get the most value possible. And we will see you in the next video.